Markets are crashing right now, and what is the psychology behind it? I look at this and say, are we going to those lows of COVID that happened in March of 2020? A lot of things tell me yes, and I'll get into a little bit of why. Let's write a couple things down. Why did we get, first of all, let's look at the S&P. Why did we get this massive instant dip right here and then this big rebound that occurred? What was the reason for this? What was the thought process down here for people? Well, we were worried because they were shutting down the world. And we were looking and saying, well, joblessness is going to be an issue. We are going to have supply chain issues. We are going to have shipping issues. Remember? Everyone was worried about that. And that's why when those companies really took off, of the shipping companies, what was going to happen coming out of there? People were going to be spending less. People were going to be taking out more debt on credit cards because of why? Because they don't have jobs. Then throw into, let's see what happened. What happened right here? All of that was supposed to happen right here. And that's why we had that big drop. Then what came in? Stimulus. Stimulus just ran this market right up. So all of these issues that I just wrote here, the Fed made that disappear by printing and just giving away all of that money. Fine. That's perfectly fine. What is happening now? Well, right now, we're starting to get this big fall in stocks, and people are saying, oh my God, is it possible that we go to these COVID levels? Well, what are we seeing right now? We are starting to see the Fed coming out and saying, 4.4% unemployment by next year. Joblessness. Do we have supply chain issues? Absolutely we do. Do we have shipping issues? You see what FedEx and UPS are coming out saying. Are people spending less? Yes, they are. And if they are spending more, what are they doing it on? Debt, credit cards. So everything I have been saying is, and then on top of that, you had the Fed doing everything. This was not even in the mix at the time, inflation. Inflation came in because of all the money that they printed. I have been saying for quite some time, we have not faced the ramifications of COVID shutting down the world, basically, but especially in the United States. We haven't faced it, and now we are facing it. Therefore, that is why I don't think it's completely ridiculous to say, hey, we're going back to these COVID levels, because everything that people said and rationalized in their mind that was supposed to happen right here has just been delayed, and now it's happening right here. So when I say that I think we're going to 220, I truly don't think it's that out of the ordinary and that ridiculous. Also, something else I want to point out. Let's zoom out on this chart right here. When we look at the last, let's go back to 2011. So this is 2011 starting here. You see this. It's pretty just gradual incline. You have your dips, you had your troughs, gradual incline, okay? Then you had this fall from COVID. And then instead of having this straight gradual line, what did we have? That. This is normal, fine, not really normal, but it's normal for what the situation we're looking at. And then you had this big spike. This is not normal. This is going to come back down, and it is going to come back down to these levels. I'm not trying to predict markets, but I'm just saying to myself, what were we looking at in 2020? We were looking at exactly what I just laid out there. So now, what can you do? Just keep dollar cost averaging. It's going to be okay. This will happen. We will get this big fall in stocks, but this gradual rise, we're going to get this over the next 10, 20, 30 years. You're going to be perfectly fine. You don't have to worry about that. I'm going to pull up an example for you. A stock that I've really wanted to own for quite some time, Nike. They reported last week. It did not go well. People were pretty scared about what was happening with the supply of Nike and what's happening in China and whatnot. I look at Nike and say, I'll put it in stock analyzer tool. I think it's probably around $55 to $60 stock. And if I go out a year, or let me go back 5 years, we were at a peak of $175 a share. I was not comfortable paying $175 a share. So what good can come out of this? Well, as stocks fall, I get buying opportunities. It doesn't change it'll temporarily change. Maybe it'll lighten the cash flows, the revenues for Nike, but over the long term, Nike's still going to be in a great position. You're still going to be able to find great companies at great prices. And that's why you take advantage of these opportunities. And that's why you need to know about what's going to happen with joblessness, supply chain issues, debt, etc. And guys, if you're new, welcome to this channel. Paul and I are investors. We go at things from a value investing perspective. We look at options. We look at chart reading. We look at businesses. We look at real estate. Feel free to check out our channel. A bunch of different videos out there. But now I want to look at the stock analyzer tool. This is a very important part of what we do and how we determine what we want to pay for a company. So I'm looking at Nike here, and I'm going to look out, and what this means is I'm going to look out at 10 years of analysis. So I'm going to put in revenue numbers, profit numbers, PEs, etc., going forward and find out exactly what I need to pay for Nike today to get the return that I want. So let's look at revenue growth on Nike. On the high side, let's say that they grow over the next decade 6% on the high side, and I'll go 2% on the low side. My idea is to really stress this thing and see where it goes. Profit margin, I don't really see much change, so let's put in 10, 10.5, and 11.5. I'm sorry, 11. Free cash flow margin, I'm going to do the same. Those should equal out over a very long period of time. PE ratio, let's go 14, 16, and 18. It might seem a little bit light, but Nike is a very large company with maybe not a lot of room to grow. And over a long period of time, I want a 12.5. I'll go a 13.5 and a 14.5% return. And let's see what this number spits out. So current price is $84. So here it is. I really need to pay somewhere. Probably I'm going to go here because I think that my 2% revenue was a little bit low. I'm probably looking somewhere in this $50 range to pay for Nike. Now, let's say I want to pay $50 for Nike, but obviously Nike is not there right now. I'm going to pull up an options chain. This is an opportunity for me to get paid to wait for a stock in premium. So let's go out to January 20th of 2023 and look at this and say $50 right here. So a $50 put on Nike for January 20th there's about a 4% chance that this event occurs, and that's called the delta. And what am I going to get paid to wait for this? I'll get about 45 cents per share. So I'm going to get 45 cents per share of Nike on however many contracts I do, and I'm going to get paid to wait there. And if Nike hits my price, if Nike hits $50 by January 20th of 2023, then I get assigned shares at $50. If it doesn't, I collected 45 cents a share to wait. Hopefully Nike's around $60 at that point, and maybe I'll rewrite the contract here at 50, hoping that I get assigned those shares. So there's a lot of different avenues that you can go when the world seems to be crashing down, that you can generate income for yourself, your family, and have a better grasp of money. I invite you to come watch the next video on margin of safety. I've just barely scratched the surface here. If you're looking to be a long-term investor, this will be a great asset to you. See ya.